Hi, I'm Barry Norris, and I'm the manager of the sector-leading Argonaut Absolute Return Fund, and I'm here to talk about low volatility and low correlation and why we think low correlation is far more valuable and certainly what we focus on in running the fund. Now, all funds want to generate positive, ideally high returns, but it's also important what risk metrics we also use to monitor our success and the success of the fund. So we try to offer uncorrelated returns. In other words, it's important to the integrity of our product that we deliver returns at different times in the market. That's our USP and how we diversify. Most absolute return funds focus on low volatility. We don't believe that low volatility by itself is intrinsically attractive. After all, cash has infinitely low volatility but offers no return. On average, we take 8 to 10% volatility in order to try to generate double-digit returns. But if those returns came at the same time as the market and therefore most other funds, we'd actually be pretty disappointed, because it would mean that like most investment products, our returns would just be highly dependent on the market direction and positive market outcomes. Now, correlation and volatility are often confused. Modern portfolio theory assumes a linear relationship between volatility and return. Now, if you actually take correlation into account as well, it means that uncorrelated assets, particularly those generating attractive returns, are actually very valuable in constructing portfolios, because it means that you can move to an efficient portfolio, one that offers a higher return without more risk, by investing in assets that are uncorrelated. So historically, in a balanced portfolio, investors would use government bonds that would appreciate in value often when the stock market went down, as this uncorrelated return. The problem is that most uncorrelated assets today offer meager returns and often obviously negative yields. So the struggle today is to actually find these uncorrelated assets offering attractive returns, and I think that's where our absolute return fund and long short equity can actually come in. It's my contention that the better the overall construction of a portfolio, the less important it is that the volatility of all the individual constituents are low. So if you need to invest in low volatility assets, it's probably because your portfolio is badly constructed in assets that are all highly correlated to each other. So overlooking the value of non-correlated, higher risk assets in an overall portfolio construction is often the biggest mistake that even professional investors make in assessing the efficiency of the overall portfolio. When we talk about low volatility, what do we mean? Well, we're talking about the degree of variation of price measured by standard deviation. But low volatility is by nature a constraint to return. A fund with a volatility of 3 to 5%, for example, is unlikely to ever have a double-digit return year. Low volatility offers zero correlation benefits. It can be 100% correlated to a market. So a low volatility fund may go up and down less than the market, but if it goes up and down at the same time as the market, it has no diversification benefits. It's also not appropriate to charge high fees on low volatility, as the fees can take up too much of the target return. So in other words, in our view, low volatility is both overrated and overpriced. Low correlation is different. Low correlation is correlation is the observed relationship between two variables over time. In our fund, it's the short book which generates the uncorrelated return profile. If we didn't short, we wouldn't be uncorrelated. Through harnessing the power of double alpha, the Argonaut Absolute Return Fund is genuinely uncorrelated and more ambitious in return. It's also true that if you just want low volatility, you don't need a hedge fund to do that. You could just invest in the market mixed with cash assets. But I think having a short book alongside a long book gives you this unique, uncorrelated, potentially double-digit return. So I think higher volatility and uncorrelated assets, if blended correctly at the portfolio level through asset allocation, is really a skill and something that obviously means that we're not just looking at low volatility assets that could be all highly correlated to each other. So how should you monitor whether the fund is doing a good job? Well, firstly, our return. Then secondly, our correlation. Run a screen of funds showing their returns versus their correlation, and look for the same characteristics in other funds. Also look how we do in negative markets. So since launch, there's been 54 months where the market has delivered negative returns. We've delivered positive returns in 32 of them. So not every month, but most months. And our cumulative return in negative months has been plus 27% against the cumulative negative return of minus 82% for the market as a whole. Finally, I can't promise that we'll do well all of the time, but what I can promise is our successes and failures will happen at different times to the market and therefore to everything else in your portfolio. This is the value of diversification. So we can also see how the fund has performed in the best and worst months for the market and how the market has performed in our best and worst months. So we can see that in our best 10 fund months, the fund has produced 80% in return, and in those best 10 months the market actually fell by 10%. Contrast this with the best 10 months of the market, which returned 76%, during which our fund only produced a 3% return. So our successes and failures happen at different times in the market. That is valuable, and that's how we diversify. So to conclude, the success for the fund would be double-digit, uncorrelated annualized returns. This is ambitious, this is unique, and this is valuable. In today's market, you can buy cheap beta easily, and also active funds that are highly correlated to beta. You can also buy low volatility funds that frankly go nowhere for high fees. The scarcity value is in high return assets that are lowly correlated, and that's our aim. And as we've said before, we don't advocate anyone putting all of their eggs into one Argonaut basket, but we certainly believe that the Argonaut Absolute Return Fund should be a good long-term egg in anyone's investment basket. Thank you.